Hello everyone, thank you so much for watching my channel once again. And today I'm going to be discussing another very important topic in as far as investing in stock market is concerned. And the topic is how to analyze a stock. So I will be sharing my 5 top ratios that I normally use to analyze a stock before considering to buy. So I'm going to be using an example of Rio Investment Trust that is operating in Kenya. It's called Fahari Late or Rio Estate Investment Trust. So that is an example of the company that I'm going to be using while trying to show you how to analyze a stock. So most of all the examples, the numbers, the figures I will be using, I will be deriving or extracting them from the financial statements of 2018 financial results. So let us begin. So as we said in an introduction, that we are going to be using all the examples from Fahari rate. So let us start with the ratios. The ratio number 1 that I consider the most single important ratio in my investing career is EPS, or earnings per share. So in simple terms, what is earnings per share? It simply means it is the portion of company's profit allocated to share of common stock. So basically it means the income that the company has earned minus the expenses, which is net income, divided by outstanding common shares. That's what basically it means. So I gave here an example of how you can calculate the EPS. So I got the net income for 2018, which is 128 basically, and the common shares, which are 180 million 0.9. So it gave us 0.7 Kenyan shillings. So that was the EPS of 2018 for Fahari Late. So what is the importance of calculating the EPS of the company before investing in it? So basically there are like 2 things that you can consider. One is the profitability of the company, as you cannot take one single year to know whether the company has been performing well or not. So what you do, basically for me, what I normally take, I take the previous 6 years of the company, how it has been performing. If there is a performance that is not good, I go ahead and check what was the problem of the performance. So basically if the EPS or earnings per share has been consistently improving over the 6 years, that will give me a good sign that in the near future, though it may not be guaranteed that in the near future it will perform well, but it is giving me a good picture that in the near future it will be performing well. So but if it has been performing poorly, if it has been declining the earnings per share, that one gives me a gloomy picture. Therefore I even stop from there. If the 6 years performance has been declining, I don't invest in that company. So basically that's the EPS. So second most important ratio that I consider when I'm analyzing the stock to buy is price to earnings ratio, or PE. So what does it mean? It basically means the ratio of company's share or stock price to company's earnings. Basically you take price per share of the company divided by earnings per share. So what is the share? By the time I was recording, the share price of Fahari Late was 7.7, and as we calculated before, we know now that the earnings per share of Fahari Late is 0.71. So what you do, you just divide the price, which is 7.7, divided by 0.71, which is the earnings per share of the company. So it will give us 10.85. So what does PE tell you after calculating? There are 2 pictures that it paints. One, it will give you whether the stock is undervalued. Second, it will give you also whether it is undervalued, overvalued compared to its peers in the same lane of operation. For example, if it is a banking industry, if it is a commercial industry, they will give you which one is undervalued, overvalued in their peers. So basically that's how you can know. So but basically if it, like, company has no peers in its line of operation, for example in Kenya, you will find that Safaricom is the only telecom company that is listed on Nairobi Securities Exchange. So you will not have any other company in that operation to compare. So what can you take? Basically, it will give you mainly the PE of 10 or below 15 is considered to be good, but below 10 actually is very good. So if you find the company has the PE of below 10, you know that that is a very good buy. But take note, you should not take only PE, you should also check other ratios, because PE is not the only indicator of good performance or undervalued. So that's how you can take the PE. So that's basically what PE shows you. So third ratio that you also consider when I'm analyzing my stock is dividend yield. As a dividend investor, I take dividend yield to be very important. Actually, let me first define what is dividend yield in simple terms. Actually, dividend yield is just a ratio of company's annual dividend paid compared to its share price. So basically, dividend yield is the annual dividend per share divided by share price. So since it is a yield, it is expressed as a percentage. So you multiply by 100. So basically that's how it is calculated. So I give you an example of how you can calculate a dividend yield. We show that earnings, the share price of the company by the time I was recording was 7.7, and the dividend that Fahali paid this year, 2018, was 0.75. So you'll get the dividend paid, which is 7.7 divided by 7.7, which is the share price of the company. So, and don't forget to multiply by 100 since it is a yield, so it will give you 9.7%. So what does the picture show us? 9.7 on surface, it is very good yield, because you are aware if you invest in that company, it will be giving you on returns 9.7%, which is completely above inflation rate, which is above the banking rate, which is even above the bond rate, since it is they will be taxing you 5%. So it shows you it is very good yield to start with. So basically the dividend yield will give you two pictures. It gives you the base or benchmark on which you should start investing. For example, myself, the dividend yield that will get me started is 5%. Below 5%, I don't invest in that company, because I'm not a growth investor, I'm a dividend investor. So 5%, because 5% in East Africa, the annual inflation on most of the countries is 5.5%. So if you don't invest in a company that gives you more than 5% average, it means you'll not be beating inflation. That is the reason why I don't invest in companies that don't give me over and above 5% as annual dividend yield. So also, improvement in dividend yield gives you a better performance picture of the company. Basically, that's how you can know what the dividend yield gives you. So fourth is dividend payout ratio. What is dividend payout ratio? In simple terms, it is the ratio of total amount of dividends paid out to shareholders compared to or relative to its net income of the company. So in simple terms, it is dividend paid divided by net income. Since it is a ratio, you express it as a percentage, so you multiply by 100. So as we are using the example of FAR late, so the FAR dividend that it paid, it was 135 million 0.7, also, and the net income was 127 million 0.8. Therefore the payout ratio will be 135.72 divided by 127.8 million, so giving us 100 percentage. So there are two things that the dividend ratio gives you. Number one is whether the company can manage to pay the dividends in the near future or not. So for example, if the company is paying more dividends than it is earning, that one paints a gloomy picture in the near future that it may not be able to pay more dividends. An example of dividend is, they always call it dividend trap. For example, recently the National Media Group, it was paying 10 shillings per share as a dividends for the last maybe 5 years. But if you have been following that company, you would see that its earnings per share has been declining. So it has been paying more dividends than it was earning. So that one, if you were wise enough, you would see that in the near future it would not manage to keep its dividend payout policy. So myself, of course, I saw it because as a person who is a dividend value investor, I saw that it would not manage to pay dividends. That's why I did not invest in it. And fortunately or unfortunately, for example, that we have been investing in a National Media Group, you know that it cut dividend to 50%. Now it is paying 5 shillings, Kenyan shillings per share. But you knew that it was not going to maintain it since it was not earning more. That's one example. Second, if the dividend payout ratio is less, it is very, very good because it can pay out ratio, and also it can also manage to get money to invest in other business to grow. So basically the companies that I normally love to invest in as a dividend payout ratios is 75% is good enough, because the 25% that remains can be able to do business. It also depends on which company. For example, this company that I've given you, it's real estate investment trust. The real estate investment trust companies, for them, they always pay more than 80% of its earnings to the shareholders, because that's one of the rules or the governing policies of the real estate investment trust, that they should pay more than 80% of their income that is earned to shareholders. But other companies, it's very prudent to, at least if you have gone exceeded, let it be 80% that is paid out. If it is paying 80%, it's good, you can invest. But if it's paying 100, more than 100, that is an alarm that company will not manage to pay dividends. That's what basically dividend payout will show you. So 5, and the final ratio is price to book ratio. What does price to book ratio mean? It just means a financial ratio that is used to compare company's current price to its book value. So book value, mainly book value, basically the book value, find the book value is just the total company's equity divided by the common shares outstanding. That's how you get the book value. So basically price to book ratio is getting the market price share, which was the market price share by the time I was recording. I told you it was 7.7, and also the book value per share, it is 20.58. So when you get 7.7 divided by 20.58, it will give you 0.37. So basically in ideal situation, it means the price should be equivalent to the book value. So if the price is below the company's book value, in theoretical terms, it means the share is undervalued. So if the price is above the current book price, like is over one, it means the share price is more than its current value. It means it is overvalued. So that's how in theoretical it means. But what is the real terms? One, when you're dealing with the price to book ratio, there are many things you have to consider, because some companies, like IT companies, they are always having high price to book ratio, because mainly they use their items or their investments is not in real assets. But if you go to, it's in your networks and what, like intangible things, so you cannot touch the exact resources or the real assets. But when you go to real estate companies, most of the real estate companies, they are always undervalued because of they have tangible assets. So sometimes book value may not necessarily mean that the company is overvalued or undervalued. The performance sometimes will increase the price to book value. For example, like Safaricom Kenya, it is like 3 times its price compared to book value. So it is overvalued. Why? Because it has been performing extremely very well. So people are willing to pay price for that growth. So for example, there are other companies like if you use Centum, it is undervalued because mainly it's not it does not pay dividends, yet it is a very good company. So there are many reasons that push down the price to book value. Or another reason why price to book value is very, very important, you have to check what kind of assets they are using to count the book value. For example, as I told you, some companies may say intangible assets, if network equipment, company image, those ones, they may be the biggest part of book value, yet when for example, if the company, God forbid, collapses, you cannot take them anywhere. For example, network equipment, they may not be that valuable, or company image, when it declines, that's it. So that's how you should see the book value. So basically, those were the 5 ratios that I normally use to analyze a stock. So there are 2 or 3 things to note. Number 1, when you're calculating or analyzing ratios, these ratios, they should go hand in hand. No single ratio is very important. Therefore, you should take all the ratios hand in hand to see how company is doing compared to all the ratios. But one like EPS, earnings per share, single-handedly can tell you how the company is performing or not. So basically, that's how you should see these ratios. They work hand in hand, so you should not isolate each ratios when you're analyzing stock. So as a dividend value investor, I always look at all the ratios while trying to compare my company. I hope you enjoyed the analysis. I hope you enjoyed the video. Thank you so much once again for watching my video. If you haven't subscribed, please consider to subscribe. And also, if you have friends who are interested in stock market, please, you can recommend my channel so that they can learn something. So don't forget to hit the bell notification. In case there is another video, please, you'll be able to be notified. Thank you once again. Have a good day. Bye-bye.